joined in by Ashi Anand, founder and CEO at IME Capital, to talk to us about markets. Ashi, great having you here. I want to first start off by getting your sense on some of these OMCs because we've seen such a strong buzz around that, and it's a very unlikely kind of sector to start a conversation with. But given the buzz, I'm trying to understand what's your sense with regard to some of these names. And of course, there's been a Jefferies report which has also come through, which seems to suggest that there is plenty of push coming in from the Ministry of Petroleum and Natural Gas to push up or likely get better valuations for OMCs. Do you believe that OMCs are undervalued? Give us that perspective.
Sure. Firstly, thanks for having me on the show. OMCs are very interesting. They clearly are relative to kind of global private peers. They would be trading at significant discounts to what other kind of OMCs would be trading at globally. And this would be because of clear risk of government interference. Whenever oil prices move up quite significantly, there are fears of kind of subsidies. You've not seen this for many years now, but you have had that historically. There are various parts of kind of pricing which is not necessarily completely in the kind of company's control. And the moment you have a situation like this, you would have investors having fairly large discounts being applied. Now, the more you move towards deregulation and the clearer you kind of have regulations around various aspects of the kind of entire OMC value chain, that would be kind of instrumental in helping value get re-rated. You have seen, if you kind of go back historically and you go back to kind of the '02 to '07, '08 period, that was the first major wave of kind of oil price or oil deregulation in the entire sector. You saw a lot of value creation happening at that point in time. At that point, they had actually started at abysmal valuations. Valuations now are at a discount, but not necessarily very, very cheap. We see kind of regulatory framework improvements and clarity as helping kind of valuations improve. However, we continue to believe OMCs are likely to be a bit more of a trading play. One, because structurally, kind of the world is moving towards renewable energy, and the longer term longevity kind of valuations of these companies are a bit suspect. The second core element is that even when there is kind of some positive improvements on deregulations, I think investors are maybe a bit suspect about how long this could kind of continue and how long a deregulated framework could hold in terms of in cases where there's very high volatility in oil prices. So yes, there could be a kind of a play here, but not necessarily long term. And we really have to see what the eventual kind of regulations are going to be, how the industry is going to shape up. But there is definitely an opportunity.
The other buzzers, and some of them we were speaking about, Aisha as well as Kunal, are something like a Godfrey Phillips up 7%. You've got a Reddington up 7, a Wockhardt up 18, a Saman Capital up 12.5. Any of those on your radar, Kunal? Any of those looking interesting to you?
Yeah, I think Godfrey is something which looks interesting. In fact, the setup for the stock, the outperformance with respect to its immediate peer ITC, I think has been quite stark over the last many years. I remember, I think Godfrey Phillips was somewhere around 1400, 1500, 2023-24, and from there the stock had started a massive rally for itself. I think it doubled in a matter of just, I think, 8-10 months from that 1500 kind of a mark, or the point when the rally started off for the stock. I think even on the short-term charts over the last 2-3 months, the stock has gone through a zone of a consolidation. It's retested the support just around the 3,300, 3,400 mark, which is also the low the stock has made over the last 4 or 5, in this last 2-3 months in 4 or 5 attempts. So I think in that sense, I think it's a good risk reward to look at Godfrey Phillips at current levels, because the longer term charts is still very bullish. Short term wise, the stock has come back towards a good support point.
Okay. What one can also see is some of those EMS plays come down quite hard. So look at a Dixon, Keynes, etc. They're some of the top F&O losers, in fact. And actually, I guess, just a whiff of perhaps tariffs coming next on electricals, that's sort of putting pressure and weighing heavy on the sentiment around some of these names. Do you think, should they crack even further, they could be buys? Or would you say avoid till you have some clarity on what Trump plans to do with tariffs and electricals at large?
Sure. So, see, any kind of trade which is a play on a 0-1 event, right? What is Trump going to do on tariffs in this particular segment? that is inherently kind of quite risky. And from a conservative stance, you'd always kind of indicate that wait to have clarity on longer term business economics before taking an investment call. I think that core principle only kind of the only way you can avoid having to wait for clarity is that if the level of discount that you're getting is so significant that it kind of from a probability adjusted perspective, the kind of valuations are seeming so cheap that it is actually factoring in worth the most of the downside and not too much of the upside. But I think by and large, it's a space that we would kind of wait to kind of see what's happening in terms of clarity. There are so many moving parts when it comes to kind of global trade. You don't know kind of what's going to happen, both in terms of import tariffs into the US, import tariff of other competing nations into the US, what kind of tariffs we are going to be implementing across different countries. There's just too many moving parts at this point in time to have clarity around a view. That said, evaluations keep becoming cheaper and cheaper. I think you will see some amount of bargain hunters coming in. But the moment you're kind of buying into a company, even if it's fallen significantly, where there's kind of upcoming news, that news will obviously have a big impact. We would actually recommend staying away.
Okay, stay away. But Kunal, on the charts, do you foresee more pressure for Keynes Dixon?
I think this could be a interesting juncture where I believe that these stocks would actually come back to a good risk reward buy, because Keynes apparently till yesterday or day before, I think that means till Friday last week, I think was actually sitting at a fresh multi-week high 7,300 400 levels. So this could actually be a good correction to really participate in case if these stocks provide another 3 or 4% percentage points correction, because there are two aspects which you look out for. One is the resilience of the stocks in the heat of the market correction, and the second is that these stocks, they hardly go into this kind of a V shape or a sharp corrective phase. They're prone to more of time-wise consolidation rather than a major price correction on an immediate basis. So I think I would actually look out for, say, another 3 or 4 percentage points if it happens for downside for Keynes Tech, say somewhere around 6,700 to 6,900 kind of a range. That actually becomes a good territory for contra traders to go in for a buy.
Ashi, Anand, curious to know your view with regard to a metal index, and it's been such a strong rally by the metal index. The outperformance has been extremely sharp. Give us your perspective. Is this sustainable? Do you expect that valuations have now reached a point where they're fair? How do you see that?
Oh yeah, so if you're just looking at kind of the metal index, right, and we keep precious metals out. If you're looking at the kind of the steel, the aluminum, and some of the kind of industrial commodities, we don't have a very strong long-term bullish view out here. And I think the primary reason behind the lack of a strong positive view is that ultimately most of these global commodities are all driven very significantly by demand and supply trends coming out of China. In an environment where there's a lot of moving parts in terms of the global economy and global trade, China has not been a key driver of incremental metal demand for a few years, and that's been because the Chinese economy has been slightly weaker. Uh, at this point in time, you don't have clarity around a strong rebound in metal, and I'm talking of more structural kind of rebound in metal demand coming out of China. You would need very aggressive infra and real estate spends to kind of come in to for China to be that incremental driver of demand. So if you don't have kind of China being a key demand driver globally, there aren't enough other countries which can kind of drive demand to an extent to lead to a demand driven price increase. The main concern we have from China is that if the Chinese economy is relatively weak, a lot of the kind of environment linked production cuts that they had implemented as they were trying to improve their environmental and various other issues around the environment, some of those production cuts may actually see a bit of halting in an environment where the kind of economy is weak. You may not actually be as aggressive, and this could lead to certain supply coming back. So we prefer to kind of participate in metals when there is a longer term structural or bit of a secular bull run that we're seeing in metal prices. That is something which, at least in the near term, we're not seeing given the kind of various elements around weakness of economic growth globally.
Right, absolutely. Kunal, the previous speaker was also talking about from Ambit Capital that perhaps some of these contra plays in the markets look good. I was just looking at the block deal on Infosys. Would you at all venture to take that punt on Infosys, TCS, etc.?
So now the price is coming back to a very attractive territory, Aisha, because there was a point where we did a ratio analysis on sectors. Like for example, in 2024, there was IT, FMCG, and I think other few sectors like PSU, specifically defense, etc., which were at the much higher end of the price curves with respect to many of the other sectors relatively. Now, the ratio analysis chart actually shows that many of these sectors, the underperforming ones, and specifically IT, to an extent FMCG, I think these sectors are at a huge curve on the downside for themselves with respect to the last 3 months, 6 months, 1 year kind of a price analysis. And look at the extent of beta correction for these stocks. TCS is not a stock which generally falls by 20-30% or rises by 20-30% in a matter of 12 months or so. But for the stock to fall from 4,500 plus kind of a mark towards sub 3,000 mark, that itself indicates that it's a very sharp kind of a correction for the stock, and same is the case with the other large cap names like Infosys, etc. So I believe that now we are in that phase of a major transition where the beta of these stocks have changed, the valuation, the price-wise, parameters are at an extreme oversold territory. In this scenario, yes, the trade looks attractive to go for a contra buy, but then we just wait for one confirmation. Like if these stocks move up higher by 5% higher from their swing lows anytime, say over the next 1 week, 10 days, that becomes a point of strong confirmation, because then the risk reward is in your favor at that point of time.
Okay, we will wait for you to give us that confirmation when you get one. That's, of course, the take coming in on Infosys TCS, wherein Kunal believes that the risk reward definitely looks a lot more favorable than it has perhaps in the last year or so. Ashi, where else are you finding or scouting for opportunities in this market?
Um, So it is a difficult market because I think you are still there's still a lack of clarity around what is going to be the key driver of kind of the markets going forward. If you go back 2 years ago, there was a lot of clarity around which were the kind of sectors or segments which were kind of driving overall market performance. Over the last year and a half, you have seen a fair degree of rotation. At this point in time, we kind of believe that in the near term, consumption and consumer linked plays are likely to kind of drive some amount of market outperformance. This is driven by the combination of the fact that you've had income tax cuts, you've had GST rationalization, and you also have interest rates having been reduced. All of these should help increase the money in the hands of the urban and rural consumer, and that should lead to some amount of a recovery in consumption. We also continue to see a lot of value in banks from a longer term perspective. We are aware that in the near term, there is some amount of growth, asset quality, and NIM pressures, but all of these seem manageable. And if you're looking at kind of the valuation, growth, quality, kind of the combination of all those three, you can get some very high quality banks trading at kind of reasonably attractive valuations with kind of longer term growth visibility. A lot of the other sectors that you're kind of looking at, with the exception of kind of banking, with the exception of consumption, and with like digital is something that we clearly have liked and continue to like over the last couple of years. It's clearly our biggest weight. But X kind of that, a lot of the other sectors either have challenges around growth, and you need to kind of have greater clarity on the growth recovery in order for those sectors to start to outperform. Or you have segments kind of like real estate, capital goods, capital markets, where these companies have kind of done quite well over the last 2 or 3 years. The growth outlook is fairly decent, but valuations are expensive, and you probably need some amount of time correction before these become attractive buys. So I think at this point in time, it's more kind of digital banking and consumer that we're kind of focusing on.
So that's the take coming in. Ashi, if I can just extend that part of the conversation, try and get your view with regard to PSU banks before I go across to Kunal, because top sectoral gainer today, but outside of that, that's one of the other pockets of resilience in this market, especially over the last couple of months. What's your sense like, and do you believe that this kind of dream run can actually extend itself for a little while more?
Yeah, so I think our view on PSU banks is quite clear. We prefer private sector banks from a longer term perspective. So if you're buying and holding something in your portfolio, I think clearly over the longer term, you will see outperformance on private sector banks. PSU banks, according to us, are a case of a valuation catch up. There was an extended period of kind of outperformance, of underperformance between 2005 to 2022 23. Over the last few years, you have seen some amount of the valuations catch up. But as kind of as PSU banks continue to improve their performance, you have seen some of them come back in terms of growth. Asset quality is no longer such an issue, and they kind of overall ROEs, ROAs, the overall economics also improving. In that context, we believe there is a valuation re-rating play that one can kind of look at when it comes to PSU banks. But from a longer term perspective, we'd much rather play the longer term consistent compounding that you get with some of the higher quality private banking franchises. Because the moment you kind of have this valuation re-rating of the PSU banks, the underlying earnings growth of these companies aren't as strong. And which is why, for a certain shorter period of time, if you PSU banks may continue to be an attractive play, but longer term, we clearly prefer private banks. Even when it comes to PSU banks, we believe there is a pecking order. We believe SBI is almost a bit of a blend between the private sector and the public sector. It's probably amongst the best run PSU banks. We prefer kind of a high quality PSU bank like SBI as compared to some of the others.
How much of this re-rating is complete, Ashi? So I understand that from a long-term perspective, private banks over PSU, but I'm trying to get to the point that we've seen a 30% rally from the lows of February 25 in the PSU index. You also seem to suggest that there is some value which PSUs still need to go up by. What is that? How much of the re-rating is complete? How much do you expect to play out?
So in our estimates, a fairly large part of the re-rating is complete.
Okay.
We'd probably say 80 to 85%. You obviously can't be too precise here, but according to us, the very large part of the re-rating is complete. You can still possibly play some amount of it, but the big move is done. And we're talking in relative terms.
Your take on the PSU banking index?
See, I'm very bullish on the PSU banking stocks, Harsh. In fact, my belief is that what we saw in 2022 to 2024 was a period where many of the PSU banking stocks gave returns of 50%, 100%. Some of them, the mid-cap funds, gave returns of more than triple digit. I actually believe that maybe not a similar phase, but a similar kind of a time-wise, uptrending is what we are seeing at the start of this, fresh move for many of the PSU banking stocks. And the best part is it's led by a large cap name, and that is in the form of SBI. You've seen a massive breakout coming out for SBI when the stock has broken past about that 820 barrier, which is a huge multi-month resistance for SBI. And then the move started to trickle into the other PSU banking names. You look at PNB, Bank of Baroda, Canara Bank, I think has been a very strong performer, Bank of Maharashtra, etc. So I think with all of these stocks coming together at the time when you have sort of a leader established in terms of a price performance, that augurs really well for the entire sector. And then we also look at it this way, that over the last, I think, 3-4 months, or maybe a slight more extended period than that, the PSU banking sector was a huge underperformer. I think if you look at the underperforming sectors and you make a list of the 3 underperforming sectors, PSU bank used to feature out in the last 4-5 months of this last 6-7 months of the price correction. So that also is playing a strong mean reversion for the PSU banking sector. So whether you are a 3-month investor or the next 3 years, I believe current levels PSU banking stocks selectively, I think are very good buys.
Excellent. Okay, so we've got 2 calls coming in on the PSU banking space. But Kunal, I'll stick with you. Give us a perspective also on the Nifty India Defense Index, and more particularly Cochin Shipyard. That one is down 6.5%. And this is on the back of what has been already a very difficult week for the Nifty Defense Index. It was down, I believe, nearly 5% through last week. Another 1.5% shave today.
So I think on the Nifty Defense Index, I actually believe that it's a good index to look at from a long-term play. Now coming straight to that, move in Cochin Shipyard, so this is more of portfolio adjustment or trading adjustment style which one has to do. When the markets are into a fine fettle, it's always a very good strategy to play trading strategies into these stocks from a short-term arena. The moment you see the markets going into any zone of volatility, you have to shy away from these names, because historically, you look at the last 2 years, you look at the last 4 years, these stocks have had massive amounts of volatility, And Cochin Shipyard is one of those stocks which was almost at 2,500. I think recently, and the stock has come back towards 1,500 mark. You look at the last 12 months of price performance from 3,400. The stock has twice gone to a 30 to 40% correction. Now that's not a very small number to digest when you look at this in terms of the extent of volatility. So I would stay away from these names as of now. But if I have to bet on the defense pack, one has to look out for names like BE and HAL. They are far more stable, far more stronger. And if you're looking at any kind of a major trend developing, these are the best bets which one can find into the entire sector.
Right, Kunal staying consistent with what he said today morning. So viewers, if you were with us, you would have got the same advice in the morning. Ashi, Anand, what's your take on defense very quickly, because I have one more quick theme to cover.
Sure. So defense is clearly very, very attractive longer term. I think I broadly agree. If you are looking at defense, some of these companies are a little more stable, a little more diversified. Companies like a Cochin Shipyard and certain other defense companies are extremely kind of dependent on a few large orders, and any kind of delays or preponements in those orders can lead to very large volatilities. We see this as a very attractive longer term theme. Probably be diversified a bit, try to be with some of the safer names. But India does have the second largest importer of arms in the world. We used to be the largest before Ukraine. There is a big indigenization program which is underway. We are at early stages, and therefore we see this as a multi-year opportunity.
EMS plays, because today you're seeing Dixon under pressure, down 5%. Now, no, I'm fully aware that this is extremely volatile in any case in terms of the stock price performance. But talk to us a little bit about, are these buying opportunities for something like a Dixon? I know it doesn't trade cheap, but at the same time, is the opportunity large enough? Margin expansion is what they've spoken about. Top line growth, not a concern. Your sense?
So someone like a Dixon specifically, I think one, like we had mentioned, we are kind of watching on what's happening on trades and tariffs, right? Because one of the key elements of trades and tariffs is that, is there then a kind of a requirement for some of the other global companies to actually set up their own shops? Some of Dixon's customers, if they come in and set up their own facilities in India, if at all becomes required, for some reasons or the other. That is actually a key risk for kind of Dixon, and that is something that we do monitor quite closely. It is important to understand that while Dixon has done incredibly well over the past few years, valuations are incredibly rich and are really factoring in a lot of this very strong execution continuing going forward. At these kind of valuations, we tend to be a little uncomfortable. It's more valuations and honestly the fundamental story, which is quite strong.
Understood. Understood. Point taken. Thank you so much, Ashi, for joining us. Thank you so much, Kunal, as always, for being